Good morning, everyone, and welcome to Julius Baer's Moving Markets podcast. It's Wednesday, the 6th of May, and my name is Helen Freer. I'll be speaking, first of all, this morning to my colleague Mike Rauber, who has a roundup of the latest in financial markets. And then I'll be talking to Nenad Dinic for an update on the earnings season in Europe. So that's coming up. But as usual, let's start with the market news. Good morning, Mike.
Good morning, Helen.
Global equities rose yesterday, supported by a run of strong corporate earnings, while oil prices slipped, although Brent crude oil did stay above $110 a barrel.
The US played down Iran's military actions against Dubai, signaling a willingness not to escalate tensions, and this definitely helped market mood. European stocks advanced on strong earnings from Anheuser Busch and record profits at Unicredit. Both stocks were up nearly 10%. The Euro Stoxx 50 advanced 1.8% on the day. In the US, markets were led by semiconductor stocks. Micron jumped more than 10%. Intel gained up to 14% on reports of talks with Apple, and AMD surged over 16% after market following its earnings release. The S&P 500 rose 0.8% on the day, reaching another all-time high, while the small-cap Russell 2000 advanced 1.6%.
US data yesterday showed the services sector expanding at a slower pace in April. Order growth cooled and input costs remained high.
Indeed, the ISM Services Index fell to a 5-month low of 53.6 points, while prices paid remain elevated at 70.7. That's the highest since 2022. New orders softened, signaling rising caution among firms and consumers. But on the positive, activity still expanded across most services industries.
And in the UK, long-term borrowing costs jumped to a 28-year high as worries intensified over local elections there and the impact of soaring energy prices.
30-year gilt yields jumped to 5.78%. Now that's the highest since 1998, while 10-year yields moved above 5%. Now this reflects investor unease over inflation, strained public finances, and political pressure on Prime Minister Keir Starmer. UK equities fell, underperforming the rest of Europe sharply, but surprisingly, the pound sterling rose on the day.
And Swiss inflation rose to a 16-month high in April, with consumer prices up 0.6% year on year. And this was driven mainly by higher energy prices.
The data also showed Swiss core inflation easing to 0.3%, pointing to contained underlying price pressures, a pattern seen in many other countries. While the central bank expects Q2 inflation at 0.5%, economists do not anticipate a rate hike before 2028, even though markets price in a possible move by year-end. One also needs to keep in mind Swiss inflation remains well below the Euro area's 3% rate.
All right. Now, US dollar asset diversification is a key theme in financial markets at the moment. We also see it in the increase in non-US dollar bonds issued by the large US tech companies that need to tap the non-US dollar bond market for their massive data center investments.
Yeah, and that also led Alphabet to complete its biggest to-date euro bond sale at 9 billion euros yesterday. And it also tapped the Canadian dollar market for the first time, raising 8.5 billion Canadian dollars. Now, the transactions highlight how Alphabet has shifted funding more decisively away from the US than other US hyperscalers.
And this morning then, Asian stocks are up 1.8%, a new record high. Brent crude is down to $108 a barrel after President Trump said the US would pause Project Freedom. That's its effort to help ships exit the Strait of Hormuz. And he cited great progress towards a final agreement.
Strong US semiconductor gains are also having a very positive impact on Asian markets. South Korea's Kospi is up more than 6%, a record high. The rise is driven by a 15% surge in Samsung Electronics, which has reached $1 trillion valuation, only the second Asian company to do so. Samsung is also seen as a potential supplier for Apple chips like Intel that I mentioned at the start. And overall in Asia, China's onshore CSI is up 1.6% after a long weekend, while Japan is closed for a holiday and reopens tomorrow. Separately, PMI data shows sentiment improved in China and India in April despite rising price pressures.
Okay, so sentiment is risk on in Asia then, and this is helping gold to advance 2% to $4,646 an ounce, and the US dollar is a little bit weaker.
Most of the US dollar decline is against the Japanese yen, actually, with the yen up as much as 1.4% to 155.70, extending gains after Japanese authorities intervened on 30th of April when dollar yen breached 160.
And over to today, we have Novo Nordisk. They've come out with earnings this morning and they've reported better than expected first quarter profit.
Indeed, the market is taking it well. Just looking, I see that the shares are expected to open about 3% higher. Other companies reporting today include BMW, Uber, and Walt Disney, to name just a few. On the economic data front, the focus is on French industrial production, and in the US, it's the ADP employment report and the US Treasury's quarterly refunding. That's all from me.
Very good. Thank you very much, Mike. Great to speak to you again today.
Thank you very much for having me, Helen.
Now let's move on to you, Nenad. Good morning and welcome.
Good morning, Helen.
And you have an update for us on the Q1 earnings season in Europe this morning. So we're almost halfway through now, and investors have been closely watching whether companies can still deliver resilient results despite the weaker macro backdrop. What are your takeaways overall from the reporting season so far, Nenad?
So the headline numbers in Europe are actually holding up quite well so far. Earnings growth for the first quarter is currently running at around 6% year on year, which is a clear improvement from the 3% projection at the beginning of the quarter. But once you go below the surface, the momentum is clearly weaker, especially compared to the US. So only 56% of European companies beat consensus earnings estimates, which is slightly below the long-term European average and also well below the US, where 84% of companies are beating estimates. And importantly, the strength in the US is much broader. So for the first time in 4 years, all 11 sectors in the S&P 500 are delivering positive earnings growth. So it's really a broad-based earnings rally and not only driven by technology. Europe simply cannot keep up with these figures at the moment.
Which sectors have been driving earnings growth in Europe so far? And do you see the outlook for the broad index improving over the rest of the year?
The earnings profile in Europe is currently quite concentrated. So oil and gas alone account for more than 1/3 of the projected EPS growth for the stock 600 this quarter. And if you exclude the oil and gas sector, first quarter earnings growth drops from around 6% to just 3.8% year on year. Looking ahead, we believe the risks to earnings expectations are tilted more towards downgrades rather than upgrades, especially since over the past few weeks, activity indicators and sentiment data in the Eurozone have weakened notably, and also companies themselves have become more cautious on the outlook. Based on the earnings transcripts, which basically can give you a rough guidance of how management is looking at the economy, roughly 1/4 of the European firms are now expecting some hit to demand because of the Iran war. And also trade risks have also re-emerged after the discussions over the weekend around the potential increase in US tariffs on European autos from 15% to 25%. The direct impact on the index level is relatively low because autos only represent around 1.5% of the stock 600, but the second round effects could still matter, especially for Germany, which accounts for roughly 60% of European auto exports to the US.
Given the more challenging macro and earnings backdrop in Europe, where do you currently see opportunities for investors?
From a sector allocation perspective, we continue to prefer getting exposure to cyclicals via financials rather than through consumer-related sectors. European banks delivered very strong first quarter earnings beats. Profitability remains structurally higher, and also the ROE is still very robust. Despite the strong performance also in banks, we also have seen that valuations remain reasonable, and we also believe that there's room for further re-rating across the sector into 2026, even if we would see a potential rate hike from the ECB, even though this is not our base case. Then also at a single stock level, we also see that dispersion remains very elevated in industrials, materials, and IT. So in these three sectors, company-specific factors have influenced the stock performance more strongly than the broader macro environment or the general sector trend. So this means that this creates basically opportunities for active investors and a more selective stock picking approach. Or in other words, the uncertain macro environment in Europe makes a pure top-down sector allocation more challenging, whereas a bottom-up stock selection approach becomes increasingly more important to generate alpha.
Okay, wonderful. Thank you very much, Nenad, for the interesting update. Great to have you back on the show again.
Yes, thanks for having me, Helen.
So that's it for today. Thanks again to today's guests and to you, our listeners, for tuning in. I hope you enjoyed the show. If you did and you haven't subscribed yet, then don't forget to do that. And please join us again tomorrow when I'll be back with more colleagues and I'll be getting their latest thoughts on what's moving markets. So have a great day, everyone, and bye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.